Video, we will discuss 4 very important things. Number 1, emergency Fed rate cuts that could be coming soon if tomorrow's data comes in poorly. And that's number 2. We have non-farm payrolls, the unemployment rate, and a speech from Fed Jerome Powell. Number 3, and probably most importantly, if you want to get rich to take advantage of this crisis, there are 3 simple steps that you can take to ensure that you benefit. Forget the morality of this. You didn't cause this crisis. If you want to be a victim of this, by all means, be a victim of this. If you want to benefit from this, well, I'll give you the step-by-step playbook. And number 4, the bear market has started. This is a bear market. The early steps towards a bear market. And unfortunately, this crash is not going to end anytime soon, according to Donald Trump and some new statements that are just out. The S&P 500 lost $2.4 trillion in market value, the biggest one-day loss since March 16th, 2020. Let that sink in. Donald Trump says markets' response to tariffs was expected. So a 5% decline in the S&P, no big deal, according to Trump. Donald Trump says that he likes interest rates going down, but they're not going down nearly as much as you would expect. We'll talk about that in a few moments. Trump says that he is open to tariff negotiations if something is, quote, phenomenal. So it doesn't look like this tariff situation is going anywhere anytime soon. Trump says the administration is looking at Chinese farmland. Trump says that he would consider a deal where China approves TikTok's sale in exchange for tariff relief. Trump was also asked about tariffs and the market response. He said, "Operation over. Now it settles in." So basically saying he thinks the pain in markets is probably over and we'll get used to it. Trump's trade advisor, Navarro, says tariffs are here to protect Americans and boost revenue. And Navarro says that, quote, tariffs are not a negotiation. Now, let me just explain something to you before we get into everything else. This is the start of a bear market. Stocks are going to fall a lot further from here. This is just the start. Okay? We've talked about this on the channel for a while now, but it's becoming increasingly more obvious. No matter what happens tomorrow, no matter if we have a really good jobs report or not, it doesn't change the fact that these tariffs, as Goldman Sachs put it, are a shock to the economy. Shocks in the economy typically lead to recessions. They don't happen all the time, but when they do, you get recessions. And markets are grossly still mispriced for a recession. And just to get to kind of pricing in a recession is, I mean, you're talking massive downside from current levels, no matter which way you want to run the numbers. Assuming EPS could fall about 15% this year from 2024, you're looking at about $201 of EPS, times that by even like an 18 times multiple, which is historically higher than any other recession we've ever seen. That would put the S&P back to 361. That would be roughly downside from current levels, not precise, but roughly, of about 32.5%. So like, we're not talking about a small fry here. I mean, we're talking about a massive crash that could be coming and is likely coming, because from all indications we can see, tariffs are not going away anytime soon. And there's not really a rush to negotiate. And even Trump's comments today here in After Hours kind of suggest that they're not even having negotiations about these tariffs. Peter Navarro says they're not up for negotiation. Everything is up for a negotiation. But again, that's the point. This is dramatically worse than the Smoot-Hawley Act of 1930 that helped cause the Depression. I mean, and that is dictated as the worst legislation that ever passed through the Senate. This triumphs that, okay, as way more destructive. And that's the bottom line principle of why markets are going to continue to fall from here. Now, recession is a big buzzword. It's 2 quarters, declining GDP growth, usually with a weakening labor market and generally weak consumer spending. Okay, that's kind of the technical definition of a recession. Whether you have a recession or not, which it looks like there's probably like an 80% chance we do have a recession following these tariffs, probably closer to 100% in just all honesty, being transparent with you. Even if we theoretically avoided a recession somehow, but these tariffs stay on, Goldman Sachs says that it could lower companies' operating margins on the S&P as just kind of a broad basket by about 32%. What do you think that's going to do to EPS? I mean, recession or not, earnings are going to come in dramatically lower than expected. So following these tariffs, there's virtually a 0% chance we get back to new all-time highs this year. And again, I'm not a financial advisor. I'm not a financial planner. I'm just here to give it to you straight. I don't care if you watch this video or not. This video is for people that want to take advantage of a bad situation that was forced upon them. Okay? You did not ask for a depression, recession, or 30, 40% stock market crash from here. Last I checked, you didn't ask for that. The best I can do is tell you how to position for it, how I am positioning to benefit from it. And it takes patience. It takes a lot of guts and courage to do what we're going to talk about next. So that's what we will get into next. How to get rich from this situation. Because this is going to make a lot of you rich. It's also going to make a lot of you poor. It really depends on the choices you make now that are going to make the difference. There's 3 things that you need to do right now if you want to get rich from this situation that is factually proven. Number 1, if you own stocks that are risky, that need to raise capital, that are unprofitable, that may or may not survive a recession, they got to go. Okay? I'm not a financial advisor. I'm not a financial planner. Each stock is going to be different, and your situation is different than mine. So come to your own conclusions and contact a financial advisor. But a universal truth is you do not get rich in a recession by holding stocks that can go bankrupt during a recession. That's a universal truth. That is tried and true, never will fail you to get out of those positions, especially if we do have a 40% decline from here in markets. What do you think is going to happen to that small cap unprofitable stock? It's probably going to 0. Okay. You need to acknowledge the hard truth of that today. No matter how much due diligence you've done on a stock, no matter how much you think you know that stock or that company, and it doesn't matter. Okay. So that's number 1. Number 2 is you need to have 0 margin. If you're fully invested in this market, that's fine. Okay. Historically, being fully invested in markets is normally a good thing. Okay. But here's the deal. If you're fully invested and you don't have any cash, even if markets fall, let's say 40% from here, you're gonna lose money, but you're still gonna be able to use margin when assets become under, distress. Okay. And that is a great thing. Using margin at the right time can be very beneficial. Okay. Using it at the wrong time can absolutely crush you. That's where it takes some patience, some courage. And, once markets are down 30, 35% from your high, that's probably a pretty good time to start looking at using some margin. Again, not financial advice. I'm not a financial planner. Come to your own conclusions. That's my plan. Okay. But number 3 is having cash is the most valuable hedge you could possibly have right now. Think about it like this. We're all familiar with inflation. Okay. We know what it means when prices go up. Okay. When prices go up, your dollar buys you less. Okay. If strawberries go from $5 a container to $10 a container, and you had $20, well, now it cost you $10 to buy that container instead of where it used to cost you $5. Your dollar lost purchasing power. In stocks, when markets fall and you get a bit of deflation, your purchasing power skyrockets. Okay, so instead of that bushel of strawberries being $5 and you have $20, now that bushel of strawberries could be $2.50. Your purchasing power of your $20 has skyrocketed. And if we do see a 40% decline, you can't look at $5,000 or $5 or $500 at face value. It's going to be worth a lot more than that. Okay, theoretically, if you invest your money with asset prices that are under distress and depressed, and then you come out after that recovery, your money is worth a lot more without getting into that too much. So a little bit of deflation in asset prices. If you have cash, it is a fantastic hedge. Okay. And that is the third thing that you should be doing right now, is raising cash, getting an extra job while you can, if you can. Mowing lawns, babysitting, taking back pop bottles and change. It sounds stupid, but $100 could turn into $1,000 if that $100 is invested during a recession and then coming out on the back end of that. Imagine $10,000 could turn into $100,000 or more. $50,000 could turn into $500,000. Pretty respectively easily, right? With quality stocks during recession crashes, logic goes out the window. You can pick up just crazy deals. Imagine if Tesla goes back to $50 a share. I mean, imagine what that recovery could look like over the next 5 years. It could be 20, 30, 40x from $50 per share, right? So that's what you need to be doing right now to prepare for this. You don't do that when markets are down 40%. Okay, you're still only down like 12%, 12% or so from your peak? Yeah, like 12%. Dude, you're in the early innings of this. So that's personally what I've been doing. Now we have to switch gears to the economic data coming out tomorrow. And the way I'm looking at this is either going to be a nothing event for markets or a big downside event for markets. It's not going to be a big positive for markets. And I'll tell you why. And it's simple. Tariffs and the economy are the big issue. Non-farm payrolls is the scorecard, okay? Like in a football game, there's 4 quarters in a football game. If the first, play, a team scores, it doesn't really change or move the odds too much for, whether or not that team's going to win the whole game, right? Same is true with non-farm payrolls. If we get a strong number tomorrow, it doesn't change the recession dynamics that we have in the economy now, okay? But, I mean, we could use a football analogy here, but I'll spare you that one. If non-farm payrolls come in low tomorrow, expectations are 80,000 on the low side and 135,000 on the high side. If we come in at like 40,000 or 20,000 or maybe even negative, well, it speeds up the timeline of this recession, right? It makes it a little bit more present that, oh crap, maybe we're in a recession already or going into one right now. That could create a lot more panic for investors. Now, what's interesting about tomorrow is this data will come out at 8:30 in the morning. Jerome Powell is scheduled to speak and has been scheduled to speak for weeks now at 11:25 in the morning. Depending on what this non-farm payrolls report looks like is going to depend on how Jerome Powell sounds like, okay? If we have a good jobs report tomorrow, Powell's going to give you a lot of what he gave you last week. Kind of cautious on the economy, hard data looks okay, we can wait and see, things are in a good place, okay? If we get, let's say, a negative jobs report tomorrow, just to be dramatic, Jerome Powell is going to sound a lot different. Jerome Powell is going to be essentially raising the red flag warning, right? And that's where talk of emergency rate cuts will start to come in. I think with a negative non-farm payrolls report tomorrow, Jerome Powell could start essentially saying that they're going to cut rates at the next meeting, that the risk to the economy is just too large, that even if there is some inflationary pressures that should be offset by a weakening economy. Hell, Jerome Powell may start talking about a recession himself, like he did in 2022. Okay. In that scenario, I don't think people are going to worry about inflation at all anymore. They're going to worry about this recession. That would cause, theoretically, TLT to skyrocket, bond yields to plummet, and markets would start pricing in a lot more Fed rate cuts, which maybe is what Trump wants from the start. Okay. So, his speech tomorrow is not going to be the same depending how the data comes out. Okay. If the data is weak tomorrow, if unemployment rates also skyrocket, as Powell suggests it could, if the jobs numbers start to come in weak, you're going to get a totally different Powell versus if the numbers come in good. So it's kind of hard to kind of forecast there. I think the numbers are going to come in weak. And if they do, you're going to have a pretty cautious Powell. And again, even say the VIX today is at 30. Okay, that's kind of high. Once you get to about 40 is when you're really looking at what could be emergency rate cuts. Okay. That's when those emergency rate cuts are on the table. Because as the markets sell off, that has a real impact in the economy. And honestly, the next Fed meeting is May 7th, about 5 weeks away, a little bit under 5 weeks away. If Jerome Powell is really nervous about this, if the jobs report does come out weak tomorrow, you could get a rate cut before May 7th. Especially, again, S&P was down 5% today. Imagine if it's down another 3% or 4% tomorrow if the jobs report does come in weak. Yeah, there's going to be a lot of talks about emergency rate cuts. And again, Powell's in a win-win situation right now. In terms of if there's a recession, you blame Trump. If there's higher inflation, you blame Trump. You don't blame the Fed. This is not Jerome Powell's fault. Okay? So in that case, it could make sense for the Fed to accommodate the economy to prevent a recession and take a gamble hoping inflation comes down in that process, right? Versus letting the economy weaken and just waiting to see what happens with inflation. It would make sense to accommodate the economy if you are Jerome Powell instead of, it's better to get blamed for a little bit higher of inflation than a recession, right? That's the more evil of two bad outcomes, right? So you could be looking at emergency rate cuts faster than most people think, especially if the VIX gets above 40. Historically, that's when you're like, that's when people start talking about emergency rate cuts, and that's when the pressure really gets put on the Fed. That is when things turn from a correction to a crisis. And, seems like you're virtually already there. But let me know what you guys think about all of this information down below in the comment section. What are you doing in your portfolios? I would love to hear how you guys are preparing for this. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.